Have you ever come across the terms self-insured retention and deductible in property and casualty insurance and thought, aren't those the same thing? Well, not quite. And understanding the difference could have a big impact, especially for businesses managing risk. Let's start with the basics. In insurance, both deductibles and self-insured retentions, or CRs, define how much of a loss the policyholder is responsible for before the insurer pays out. But they operate very differently, and those differences matter in how claims are handled, how cash flow is impacted, and even how premiums are priced. So, what's a deductible? A deductible is a fixed dollar amount that the insurer subtracts from the total claim payment. The insurer still manages the claim from day one, but they only pay the amount after the deductible is applied. Let's use an example. If you have a $1,000 deductible and you file a claim for $10,000, the insurer pays $9,000 and you pay the remaining $1,000. Pretty straightforward. Now let's talk about self-insured retention, or SIR. An SIR is the amount you, the policyholder, must pay and manage before the insurer is even involved. In other words, you are self-insuring that portion of the risk, not just financially but also operationally. If your SIR is $100,000 and you have a claim for $75,000, the insurer doesn't get involved. You handle the whole thing, including legal costs if applicable. But if the claim is $250,000, you're still responsible for the first $100,000, including investigation, defense, and settlement, before the insurer covers the remaining $150,000. So what's the key difference? With a deductible, the insurer manages the claim and simply deducts the agreed amount. With an SIR, the policyholder takes on much more responsibility. They handle the claim themselves up to the CR amount and only bring the insurer in above that level. Let's break this down in real-world terms. Large companies, municipalities, and sophisticated commercial policyholders often choose CRs because it gives them more control over claims and can help reduce premium costs. They may even have in-house legal teams or third-party administrators to manage the claims process. But that control comes with risk. If you don't have the resources or expertise to manage those claims effectively, it can backfire, both financially and operationally. So how does this affect insurance pricing? Insurers typically charge lower premiums for policies with high SIRs because they're taking on less frequent claim involvement. But with that savings comes higher volatility for the policyholder. On the other hand, policies with low deductibles may have higher premiums, but the insurer is doing more of the work and the policyholder takes on less direct responsibility. So, which one's better? It depends on the size and risk appetite of the policyholder. If you're a small business or an individual, a deductible makes more sense. If you're a large organization with risk management infrastructure, and SIR might offer more flexibility and cost control if you're equipped to handle it. And finally, what about regulatory considerations? In some states or industries, the use of SIRs may come with additional compliance requirements, such as maintaining a letter of credit or showing proof of financial solvency to ensure the business can cover large, self-insured losses. As insurance becomes more data-driven and policyholders seek more tailored risk solutions, we'll likely see more hybrid programs that combine elements of both deductibles and CRs, depending on the exposure and business model. Understanding this difference is key to choosing the right risk transfer strategy and making smarter insurance decisions. If this breakdown helped clarify the topic for you, be sure to like this video, subscribe to the channel, and follow Insur Knowledge for more educational content on how P&C insurance really works. We simplify insurance so you can navigate your world with more confidence. Thanks for watching.